As the national average for 5-year CD rates sits below 1% annual return, EverBank is out with a new type of CD for savers who are looking to squeeze a little bit more out of their cash. We have Chris Gaffney, Chief Investment Strategist at EverBank in St. Louis. Chris, thanks for being here.
Well, thank you. It's a pleasure being here.
So Chris, this new CD that I just mentioned would give participants exposure to the Colombian peso, Mexican peso, the Turkish lira, and the Indian rupee. What exactly is this certificate of deposit that you guys are offering?
Well, it's called the Evolving Economies Market Safe CD, and the return is going to be based on the return of those 4 emerging economy currencies. So it's a market safe CD, and based on the fact that no matter what happens to those currencies, your principal is protected. So you cannot lose money in this CD.
So people who are very familiar with a typical 5-year CD are probably wondering, how does this differ from what they're used to?
Yes, it doesn't have a stated interest rate, so it's a 5-year term, and basically we take and divide equally the funds that are placed into the CD into those 4 different currencies. And your return on this CD is going to be based on the return of the average return of those 4 currencies. So we set the price of those 4 currencies at the beginning of the CD and then compare them to the average price of those 4 currencies over the 5-year period. At the end of that 5-year term, the depositor will be paid back the return of those 4 currencies compared to their original pricing. If that happens to be 20%, the depositor is going to receive 20% on the CD. If that return is negative, the depositor will receive their original invested principal back.
So then what's the advantage of someone jumping into this CD as opposed to just putting their cash in a typical CD that's going to give them a return of 0.81%?
Sure, and that's the advantage, is that typical 5-year CDs today are very low. They're not paying much interest at all. This gives you an advantage of investing into these emerging market currencies, evolving economies, that have a lot of potential upside. So you get all of that potential upside without any downside risk. So really the opportunity cost of investing into this CD is simply the current 5-year CD average, which isn't much interest.
Right. So the worst case scenario, though, is that you don't earn any yield whatsoever from those other currencies, and you just end up after the 5-year term getting the money back that you put in.
That's exactly right. And this CD also has a unique feature called a jump note. So if at the end of the 5 years, the average price of those currencies has increased between 0 and 15%, the depositors are going to receive 15%. So even if the average of those 4 currencies go up just 3% over the 5 years, depositors are going to receive 15%.
All right, Chris, interesting stuff. Well, thanks so much for giving us your take on this new type of CD you guys are putting out.
Not a problem. I enjoyed it.
For The Street, I'm Joe Doe.